The first rates are in and the Nifty is down about 12 points.
Exactly at the 17,000 mark on the Nifty, a cut of 0.5% on the benchmark indices.
The market's taken a tumble back to the low point of the day, 16,922.
The mid-cap index is a relative outperformer for bulk of the trading session, but towards the end, that as well did give away that advantage, ending in step with the Nifty down 1.3%. Hello and welcome to CNBC TV 18. You're watching Markets Today, the show where we trace around 6 hours of the trading action in just 5 headlines. I'm Nigel D'Souza. Let's get straight to the headlines for the day. Weak global cues, royal sentiment on Dalal Street. The Sensex declines over 600 points. Nifty is down 200 points. All sectoral indices end in the red. Banking stocks get a harder knock. ONGC and Oil India gain after the government revises its gas prices and cuts windfall tax on crude. But gas distributors slip on higher cost. Autos take a beating after reporting a mixed bag in sales for September. The Nifty Auto Index closes 2% in the red. Passenger vehicle makers like Mahindra & Mahindra, Maruti as well as Tata Motors, they tumble despite seeing strong sales in the previous month. Exports for two-wheeler segment remains under pressure. Coal India gains close to 1.5% after achieving 43% of its production target for the year. Meanwhile, the Nifty Farmer Index is the only sectorial gainer. Lupin's up 6%, Oro Farmer gains 5%. Crude oil prices surge on supply concerns. Both Brent and NYMEX are up over 4% as OPEC nations consider yet another production cut. Well, here's what we have lined up on the show for you. It's a power-packed show as always. In Market Opinion, we have Harsha Upadhyay, President and CIO Equity at Kotak Mahindra AMC, and Abhilash Narayan of Standard Chartered Bank. In Corporate Voices, we have the top brass from the auto space. Well, let's start with the market action first. Weak global sentiment is playing spoilsport as stocks came under pressure. The Sensex was down 600 points. The Nifty was down close to 200 points. With this decline, all gains made on Friday, well, they got reversed. Anuj Singhal is standing by to run us through the market wrap. Anuj?
Well, the market had a bit of a rout today, the global market that is, and India was part of that. Of course, there's a fear of contagion risk emerging out of what's happening with Credit Suisse. For our market, we were sitting on some heavy gains from Friday. So in any case, the market looked a bit on the heavy side. Banks are high beta now. They led the rally on Friday and they led the decline today. So names like SBI, Kotak, IndusInd Bank were all lower. Auto stocks also did see some profit taking. So names like Eicher Motors, Maruti and Tata Motors were down. Some stocks managed to gain today. ONGC clearly was on the beneficiary side today, so that did well. Dr. Reddy's Pharma has been doing well of late and Coal India was higher. But really the last hour of trade belonged to the Adani Group stocks on the downside, led by Adani Enterprises, which of course is the latest entrant in the Nifty. Adani Ports as well and the others, Adani Green, Total, Transmission, Power, Wilmar, even Ambuja if you want to include that. So all these stocks had a bit of a collapse in the last hour of trade. All said and done, this is a market which is still trying to find its feet because it's still hostage to what's happening in terms of global cues. Let's see whether the market can move on from here in terms of some recovery tomorrow.
Thanks a lot for that, Anuj. Well, in Market Opinion, Harsha Upadhyay, President and CIO Equity at Kotak Mahindra AMC, says that India is relatively better placed as growth continues and inflation is relatively under control. Abhilash Narayan of Standard Chartered Bank is bullish on the Indian markets. Let's hear them out.
I think India has been a bright spot in an otherwise challenged global economy, I would say. While we have done much better than most other markets in the recent past, the trend also continues. But we need to remember that we can't be immune to the kind of volatility that is likely to be there in the global equity markets. Having said that, I would say that the problems at Indian economy is much lesser as compared to what you would see globally. For example, the negative real interest rates across the globe is much higher than what we are witnessing in India. So to that extent, the interest hikes that would be required in Indian economy would be a lot lesser. So the growth impact is going to be a lot lesser. Even after a couple of interest rate hikes, our economy has been resilient in terms of growth.
We have been bullish on Indian equity markets for the last 3 to 6 months. And it's played out as we expected, right? And the key drivers that we have been highlighting haven't really changed. So obviously, India, as we all know, is expected to grow much, much faster than the rest of the world. Yes, RBI did reduce the FY23 growth forecast from 7.2 to 7%. But when you think about it in the context that growth expectations in US for 2023 are less than 1%, for UK, growth is expected to be negative. And in China as well, growth recovery is expected to be slow. So India really stands out as being a high growth market. If you look at equity earnings expectations, we expect around 16% EPS growth over the next 12 months. So that's, again, substantially higher than what we expect elsewhere.
Well, just 24 hours ago, the British Prime Minister said that she is absolutely committed to the proposed tax cuts. But today, a U-turn. The British government has reversed its decision to cut the topmost tax rate from 45% to 40%. The move comes after widespread backlash and market turmoil. Lata joins in to run us through her take on this. Lata?
Yes, the UK has done a U-turn. The government has withdrawn its proposal to reduce tax rate on the highest bracket from 45% to 40%. Actually, this step was among a package of tax cuts that were announced on September 23rd to revive investment. Besides lowering the tax on those earning more than £150,000 to 40%, the government had also brought forward a plan to cut the basic tax rate from 20% to 19%. Now, this plan had been advanced from 2024 to 2023. Also, the package included stamp duty cuts on property transactions. They were cut to encourage home building. Other SOPs to companies included lower mandatory insurance payments and higher investment allowance. All those have been kept intact. But the cut in taxes for the high earners was important because this category contributes about 36% of the income tax kitty. The tax cuts drew criticism because they come at a time when the government is actually committed to huge energy subsidies to shield people from the high gas prices. This clearly meant the government will have to borrow more. Also, markets expected that the Bank of England will have to hike interest rates, because tax cuts mean there is more purchasing power in the hands of the rich, and that can push up inflation, which is already in double digits, 10%. As a result, yields on the UK 10-year gilt shot up from 3.5% on September 22nd, the day before the cuts, to 4.5% just in 3 days, September 27. On September 28, the Bank of England stepped in and said it would buy UK bonds to ensure financial stability. Actually, the pound too had fallen very sharply from $1.12 needed to buy a pound. The cost fell to $1.07 to buy a pound. Now, the reason for the U-turn on cutting the top tax rate seems to be partly market reaction and, more importantly, opposition from many in the Conservative Party itself, who worried that they can't be seen to be giving more money to the rich when common people are unable to afford food and fuel. The mixture of capitalism by way of tax cuts and socialism by way of energy subsidies just didn't work. Not for the markets, not for the voter, not for the Tories.
Okay, all right, Lata, thanks so much for making sense of that for us. Well, let's move on then, and that's to the second headline now. ONGC and Oil India, well, they saw healthy gains of close to around 4% after the government hiked gas prices and cut the windfall tax on crude. But gas distributors, well, they slipped on higher cost. Sonal joins us to run us through a quick analysis on all of those stocks. Sonal?
That's right. A lot of policy updates that we've seen in the oil and gas space. Let me start with the domestic gas price hike. It has been increased by 40% for the second half of FY23 to $8.57 per MMBTU. And this is the highest level that we've seen since 2014. Now, ceiling for gas from difficult fields has been set at $12.46 per MMBTU, which is up 25%. Now, there was a committee that was set up to change or revise the gas pricing formula. And now they will submit the report on pricing formula by mid-October, and this will then go to the cabinet for its approval. How does it impact stocks? Well, IGL requires to take a CNG price hike to the tune of 8 rupees per kg, MGL by 9 rupees per kg, and this is something which will impact volumes because companies will not be able to, if they do actually pass on the price hike, demand will go down. Gas costs for GAIL's LPG segment will go up, and that is something that will impact margins for them. Reliance Industrials will see a respite because of the higher pricing that they'll see in the KG basin. It is a big positive for ONGC and Oil India as well. The second positive thing that has happened is the windfall taxes on crude oil production. They have been cut to 8,000 rupees per ton versus 10,500 rupees per ton. Export duty on diesel has been halved versus the last revision that we have seen, and aviation export duty has been scrapped completely. CLSA says it is a $5 per barrel cut for oil companies, that is oil producers, versus the $4 barrel per cut in taxes that we saw earlier. And this is something which is positive because it is factoring in a $74.9 per barrel oil realization for these companies, which is much higher than the $40 per barrel which these stocks are right now valuing or actually factoring in. So these are the positive things because of which ONGC was higher. However, city gas distribution companies under a lot of pressure today.
Formula was more or less suggested in 2012 and somewhat supported in 2016 report of the secretaries, which really tries to give the same price to Indian producers of APM gas as prices producers get in international market. And I think we are examining this, and we will come up with our ideas on the subject in a month's time, latest by end of October.
Moving to the third headline now. Major auto stocks, well, they took a beating after reporting a mixed bag for the past month of September. Passenger vehicle makers like Mahindra & Mahindra, Maruti as well as Tata Motors, they saw strong sales, but two-wheeler exports remained under pressure for the said month. Eicher Motors stock, well, it tumbled by close to around 5%. The likes of TVS Motors, Maruti lost close to around 3%. Sonia standing by to run us through the big trends coming out from the past month. Sonia?
Well, thanks a lot for that. There are three big trends that we noticed in the auto sales in the month of September. The first trend is that passenger vehicle sales have come back in a big way. M&M has reported an all-time high sales for its passenger vehicles this time around. The auto sales have gone up 129% year-on-year, led by a sharp surge in the SUV segment. In fact, M&M says they now have a #1 position in the SUV space with a market share of over 19%. Maruti as well saw a 104% year-on-year rise in auto sales at 1.76 lakh units, and the management says that they expect the industry to see a growth of 24% year-on-year to 3.8 million units. Tata Motors too, its passenger vehicle sales went up 85%, led by a big surge in the electric vehicle sales. The second big trend we notice is that two-wheeler exports continue to be under pressure because of the issues that we're seeing in regions like Nigeria and overall in Africa. So if you look at it, Bajaj Auto's export sales were down 33% year-on-year at 1.4 lakh units. They said that the Africa business is down 20 to 25%, and things are still very uncertain over there. And TVS Motor as well reported an export sales fall of 9.2% on a year-on-year basis. Finally, the third trend is that farm equipment sales have come back in a big way. Both M&M and Escorts reported very healthy growth. In fact, M&M has reported its highest ever domestic monthly tractor sales at 47,100 units, which is a growth of 20.6%. Escorts too reported tractor sales growth of 38% year-on-year, saying that the festive season will continue to boost demand, as well as Kharif crop harvest starting soon and crop prices holding firm. The sentiment is positive in the tractor sector.
Okay, thanks a lot for that, Sonia. Well, moving on then, Indian corporate balance sheets are at the healthiest in the past 10 years. That's the verdict that's coming in from rating agencies. Rating agency CRISIL score shows that the number of upgrades were 5.5 times the number of downgrades, with 567 upgrades and only 103 downgrades. For rating agency ICRA, well, the upgrades were nearly around 3 times the number of downgrades, with 250 upgrades and 76 downgrades. Lata is back with us to run us through more details on that front. Lata?
Yes, corporate balance sheets definitely getting healthier. A little more from CRISIL. Like you said, 5.5 times the number of upgrades to downgrades compares to an already healthy 5 times the number of upgrades to downgrades in the half year that just went, the one that ended on March 31st. The CRISIL report also said that the average leverage gearing of companies has touched a decadal, a 10-year low of just half of their equity, 0.5 times equity this year. The other positives, capacity utilization is up, and there is a very healthy demand. The risks, they say, is only that there is a developed market recession and the rise in rates. those are the risks to future upgrades. CRISIL says that the key takeaways from their study, the best sectors are pharma, the most buoyant sectors, pharma, specialty chemicals, hospitals. They are going to see cash flows, operating cash flows of more than 10%. That's the growth. The middling sectors are infrastructure and renewables. They will see a moderate cash flows, not as high as, growth of 10%. And the sectors that could be under a bit of pressure are those that are exposed basically to exports. Textiles, pharma, IT, agrochem, and dairy. Of course, IT does not have a problem in terms of loans. ICRA basically echoes the same. Just look at their H1 over the past 3 years. The number of upgrades have consistently gone up and the number of downgrades are consistently going down, as you can see. ICRA adds that their upgrades have grown this half year at 18%. The 10-year average for the growth in upgrades is 11%. So that's why it's a 10-year high. And they basically are seeing the same sectors as buoyant: real estate, textiles, financials, engineering, construction, especially roads.
Okay, all right, Lata, thanks a lot for that. For the time being, we'll slip into a short break. We'll be back in the jiffy to run you through the remainder of the headlines. Welcome back. You're still with us on Markets Today. Well, let's go through the rest of the headlines that we're tracking for you, which brings us to the fourth headline today. Coal India was a relative outperformer, up close to around 1.5% after achieving 43% of its production target that it set out for FY23. They came out with their operational update for the month of September, and on the dispatch front, well, it looked quite good. It was up close to around 1% odd, but that's on a high base. So 49 million tons is what they achieved for the past month or so. On the production front, well, it continues to look good. It was up close to around 12%. But for the first 6 months of the year, things are really looking very good. Offtake was up close to around 8%, production was up close to around 20%, and those data points are quite encouraging. For FY23, they had a particular target. And in the first 6 months, on the offtake parameter, well, they've achieved close to around 102% of what they set out to. Not just that, on the production front, they say that they had a target of 700 million tons, and they're sticking by that. Till now, they've achieved close to around 43% of the production target. And as we know, the second half of the year is relatively better. So they expect a good growth in the second half of the year. Besides that, it has cash in its books. It's a dividend yield stock as well. The only fear is the stock has corrected from the recent peak, because the fear is maybe the government could possibly take some money off the table via some divestment. No confirmation on that front. But from the recent peak, the stock corrected close to 10%. And today, though, it did see some buying at lower levels. And that's why was a relative outperformer. But talking about gainers today, well, Pharma Index, that was the only sectorial gainer well in the green in an otherwise weak market. But it closed with gains of close to 100%. You had stocks like Lupin, Zydus, Oro Pharma. All of them were up close to around 5%. Ekta joins us to run us through a wrap on the pharma sector. Ekta?
Well, yes, pharmaceutical stocks have been buzzing and continue to do so in today's trading session. One of the reasons, obviously, is some amount of defensive buying which is coming in. But besides that, maybe there is some amount of incremental positivity when it comes into the fundamentals. For example, the US price pressure is expected to reduce to around 5 to 8% versus the heightened levels of around 10 to 15% earlier. The Indian pharma market, that is estimated to continue growing in double digits, 11 to 12% in the next 3 years. Also, one of the big headwinds which the street was fearing, which was basically the essential list of medicines for 2022, that too has been announced, and hence one of the big headwinds or uncertainties is now out of the way. Separately, a lot of companies or analysts are bullish on the Revlimid generic opportunity, which is basically the blockbuster cancer drug. For Dr. Reddy's, for example, estimates are that they could make around $500 to $600 million in the next 3 odd years, and the others such as Cipla as well as Zydus could make up to around $300 million in the next 3 years from this particular opportunity. Now, specifically Cipla, remember that stock has been gaining a lot of momentum and has been outperforming. The street seems to be optimistic on Revlimid generic, on other opportunities such as Advair generic, as well as the company is guiding for around 2 to 3 complex generic drugs per year in terms of a launch. Lastly, risks continue. One of the biggest ones is the US FDA inspections picking up. Recent inspections acquisitions included the likes of Biocon, Cipla, Glenmark, Torrent, and a couple of them US FDA challenges continue. For example, Cipla, Glenmark, Lupin, Aurobindo. Now, other risks also include US price pressure not going as anticipated, for example, not deflating, challenges in the launch pipeline, and fear on the cap of trade margins when it comes to the India business and large amount of discounts. While stocks have corrected significantly and have got up as well, they are quite significantly away from their 52-week valuations, except for a handful such as Cipla and Sun Pharma.
Well, thanks a lot for that, Ekta. Moving on then, SEBI announced a series of measures on Friday after a board meeting. The market regulator has issued regulations for stricter IPO disclosure. They've also introduced pre-filing of IPO documents along with some others. Yash Jain, well, he's always the man for the job with regard to what SEBI announces, and he joins in to run us through the key takeaways from SEBI's announcement. Yash, over to you. Explain it to us.
Well, that's correct, Nigel. So you said a series of changes brought about by SEBI. I have picked 5 most important ones which one needs to look at. The first one is stricter IPO disclosures. Here, market regulator SEBI has said that all companies, new age or traditional, will have to disclose key performance indicators or KPIs along with the traditional financial matrix in the DRHP document. The second one is that companies wanting to come out with an IPO will have to disclose the price per share of the past transactions which have happened in the previous 18 months prior to the IPO. Well, if there have been no transactions in the previous 18 months, then in that case, companies will have to disclose the price per share of the last 5 transactions which have happened in the last 3 years prior to the IPO. The third one on the IPO front has been introduction of pre-filing of IPO. This is essentially companies can go to market regulator SEBI, file their documents in confidentiality, not disclosing the key sensitive business information to the regulator, and as they get closer to launching the IPO, they can disclose those key sensitive information in the public domain. The next one is modification around OFS framework. Now there is no threshold of 10% in terms of shareholders wanting to sell through an OFS. There is no threshold as such. That has been removed. There has been some amendment around open offer. Here, SEBI has removed the dispensation considering 60 days when it comes to volume weighted average market price when it comes to strategic divestments of PSU companies. And finally, market regulator SEBI has decided to include mutual fund units under insider trading regulations through a separate chapter.
Okay, all right, Yash, thanks for that. Well, finally, the fifth headline today, crude prices surged over supply concerns. Meanwhile, crude prices was down close to 20% in Q3 owing to weak demand. Manisha joins in to run us through details on that front. Manisha?
Yes, there is a sharp uptick in the crude oil prices, and this is especially after nearly 7% decline in the month of September and 20% of a fall in the quarter gone by as well. But it is about the weakness in US dollar index, which has come back from the 20-year highs that we saw in the previous quarter itself, the previous fortnight as well. And then it is also about the OPEC and allies meeting, which is happening on 5th of October, where the markets are working with the fact that you could be looking at a 1 million barrels per day of a cut coming in from OPEC to ensure that the prices hold at these current levels. It doesn't augur well for OPEC if the prices fall to below $80 a barrel, and we have seen that level a few times in the previous week itself. Well, if you look at the global markets right now, we are working with a deficit of around 0.6 million tons. If OPEC and allies do cut 1 million barrels per day, then we will be looking at a deficit of 1.6 million barrels per day. So this is what the markets are calculating right now, and you have seen that premium come in for prices. The third factor is really about the European Union, where they have put out a date as 5th of December when they will ban Russian oil and gas. The markets are not self-sufficient right now, and with Russia cutting output and European Union ban on Russian oil and gas also seems to be adding premium to prices. So this quarter promises to be quite volatile, but the markets do believe that it is going to be more bullish rather than bearish for this quarter. We already have seen the hurricane season begin, and with the kind of deficit we are working with and the kind of stronger data that China finally is coming out with, the Chinese demand could be coming back into the markets as well. So all factors as of now pointing towards better crude prices going forward.
Thanks a lot for that, Manisha. Well, on that note, though, we'll wrap up on this edition of Markets Today. Thanks so much for watching.